Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you.
Welcome back to the Winner's Playbook. I'm Josh here with Billy as usual, and today we're going to be talking about what happens when your super gets too big. With the new Division 296 tax coming in July, balances over $3 million will face extra tax on their earnings. Some high net worth investors could be looking at massive tax bills, and we're actually going to be breaking down one in particular of which could cop a $30 million tax bill in the next financial year. So if your super balance is getting up there or you're aiming for it, we're going to break down what you ultimately need to know. And before we get into that, Billy, I'll throw to you, mate, in terms of anything new or what's sort of happening in your world this week.
No, mate, just scrambling towards June 30 as usual. And we're off to Singapore in a few weeks, so thinking about that as well. Yeah, that's really the focus. How about you?
Yeah, I haven't actually. Have you done Singapore before? I haven't done Singapore yet.
Just the transit lounge, the airport.
Okay. Plenty to explore there. Yeah, I haven't been through even the transit lounge at this point in time, but yeah, looking forward to Singapore. Down in Tassie next week, seeing the team. Just going to be working from our office down in Tassie for a little bit, and yeah, just in the personal life, just been really enjoying like jiu-jitsu, and I do that a couple of mornings every single week at the moment, on a Tuesday and a Thursday down at Gracie Jiu-Jitsu, and just absolutely loving it. Like, I've done martial arts in the past, and now I've gotten back into it, starting from white belt again. So I was a black belt in another style, but jiu-jitsu is very different, and it's like an amazing chess match, basically, is the way I can describe it. But it's just so many levels to it as well. So very much enjoying that. And yeah, life's good, can't complain. But yeah, end of financial year is coming up, and it's pretty frantic leading up to the end of the financial year, as you mentioned. But yeah, we're going to be diving into Div 296. Before I do that, I'll go through a bit of an article to really talk about this one fund we're going to focus on in particular, that's really going to help us dive deep into how Div 296 works. But just before that, Billy, have you had any clients asking you at this point in time around Division 296 and concerns being raised?
Yeah, definitely. If some clients ask about it, but they're not people that were going to be affected by it necessarily. Like, it's the media doing that scare campaign type thing, like, watch out, they're coming for your super. But the reality is, at this stage, this tax only affects a tiny percentage of Australians. So most people who raise it probably won't ever be affected by it. I do have a couple of clients with bigger balances who may be affected. But the conversation is just, look, as soon as we know exactly what's happening and when, we can easily have a strategy to deal with it. Because for most people affected by this, they're probably in retirement, which means they do have full access to super. So we can move assets around if we need to.
Yeah, it's a good point. And when we come to the close on this podcast, we might talk about, I suppose a lot of people are worrying, and particularly financial advisors, and everyone should probably be worried about it, in terms of it might just be a bit of a dangerous precedent in terms of how this Div 296 tax is going to work on assets and taxing unrealized gains, and then how that could maybe change for other investments or structures maybe down the line. But we'll get to that in due course. But what I figured I would do to really set the scene here on one self-managed super fund, which could be up for a $30 million Div 296 tax bill, which is huge. And we're going to use this to really talk about why superannuation is also so tax effective, and how you can structure your wealth through it, and some of the ins and outs actually relative to that. But there's a gentleman by the name of Charles Gibbons, who's a director of WiseTech, which is actually a publicly listed company, a very, very large company. And to set the scene here, he owns a large amount of shares in this publicly listed company through his self-managed super fund. So self-managed super fund, we have spoken about on other podcasts, quite different to a regular super fund, because you can pretty much invest in whatever you want in those situations. You can buy publicly listed companies through some superannuation funds these days. They don't have to be a self-managed super fund, but generally, if you want full investment freedom, that's what a self-managed super fund is for. But basically what happened is, last year, December 5th, he sold around $200 million Australian worth of WiseTech shares through his self-managed super fund. And then you might go, well, that's massive, because it is. And well, wouldn't he be up for a huge amount of tax? But that's where the benefit of super is, because it's owned through his superannuation. The tax rate maximum right now is only 15% on those earnings. Or in the event of a capital gains situation where he's selling a large amount of shares and they've been owned for over 12 months, the tax rate on that is only 10%. You can't beat that in Australia in any sort of other structure, or in your own individual name. You could be paying tax of up to 47%. Can you imagine 47% tax on $200 million? That's huge. So
That's wild, yeah.
it really is. And so he sold $200 million worth December last year. The tax rate on that is then going to be 10%. But then the other part of it is he still does own a hell of a lot of WiseTech shares through his self-managed super fund, to the tune, based upon the current share price. His shares in WiseTech through his super fund are worth nearly $1.7 billion, which is just absolutely astonishing to even think about. And I had to just read this article again when I actually seen that. So clearly it's one of the largest super funds here in Australia. And we're going to talk about how that can even happen. How can you even get so much money into super when there's restrictions on how much money you can actually get into superannuation in the first place? But the article goes on to actually explain that the ATO hasn't disclosed the exact values for all of the largest super funds or the self-managed super funds here in Australia, but it is detailed that the average for the top 10 was 423 million. So there are some very, very big super funds out there. And then this leads into the whole conversation of, for those large super funds and Div 296 tax, which I'll throw to you in a second, Billy, to just kind of unpack and give us the nuts and bolts of how it works. When this Division 296 tax comes in from July 1st onwards, Mr. Gibbons here could be up for a possible tax bill for Division 296 of over $30 million in the next financial year, which is huge. But let's also just take a step back and look at how much wealth he's got just through superannuation. And I'm sure that's not the only amount of wealth that he has got. $31 million if you've got $1.7 billion in a company. I'll take that deal any day of the week. So I'm okay to pay that $31 million tax bill. But I'm sure he will have accountants and financial advisors around him doing all of what they can to structure his wealth and shares, in the most optimal manner moving forwards in light of Division 296 coming in. But yeah, Billy, maybe just first of all, what were your thoughts when you're seeing that? And can you then start breaking us down what Division 296 tax is and how it actually works?
Yes. My thoughts when I first saw this article. Well, one of my thoughts was, I wonder if Jim Chalmers has brought in this tax just for that one, just to smash that one super fund. Maybe that was part of the motivation. Because at the end of the day, I think that's why they created this tax. They know it only affects a small number of people, and therefore, we're not going to lose many votes on this one, I think is the philosophy, and raise a few bucks, pretty quickly. Yep. So I think that's where it's sort of been born from. How do we bring in a new tax where most people, don't give a shit because they're not affected, type thing? Exactly.
Yep.
Yes. So the purpose is, if you think about it, that those giant super funds, it's sort of one of the last, I guess, loopholes, or one of the last sort of strongholds of like tax structures where really wealthy people can stash a large amount of assets and not cop a high tax rate. Mm-hmm. So it's probably like, this is what happens in the Australian tax system. They sort of close these loopholes over time as people find them and use them. Mm-hmm. I think that's sort of where it's come from. How does it work? Well, as you pointed out, a few years back, more restrictions were brought in around super in terms of how much you can contribute into super, how much you can use to start a tax-free pension at retirement. Those restrictions were brought in, but there was no hard limit on the total balance that you can accumulate. And so in that example, the WiseTech one, he hasn't contributed a huge amount into super. He has invested his super into the stocks in this case, or into WiseTech. He's invested into something that's generated a gigantic return that's resulted in a gigantic balance. So that's why there's only a small number of people who've been able to achieve that. The way the tax works is they've decided to target anyone who has more than $3 million in superannuation. At the moment, the tax rate on super is 15%. It applies to income generated by a super fund. It applies to realized gains. So when you sell an asset at a profit, it applies to that. They've now brought in an additional 15% that will only apply to those individuals in more than 3 million super. And this is the controversial thing. They're saying that will apply to unrealized gains. So for Mr. WiseTech here, like if he doesn't sell any shares under the current system, he won't pay tax because he hasn't realized a gain. Under the new system, it doesn't matter if he sells or not. They're going to capture the increase in the value and hit you with a tax bill.
Yeah, scary stuff when you think about that being taxed on an asset of which hasn't even been sold. And because I did a video on my TikTok a couple of weeks back talking a little bit about this, because, you know, a lot of people are like, well, you know, there's not many people out there with over $3 million in super, which is a fair point. But the point that I was talking about earlier, like, is this sort of setting a bit of a dangerous precedent? Because if that was, say, applied to just everyday people owning investment properties, not saying that that's going to occur, but who knows what happens down the line. Think about it like this. Anyone listening, if you own an investment property and say it's worth $1 million and then it goes up to $1.2 million, that gain, if we use a simplistic scenario, could be taxed, even though it's unrealized. You haven't sold the actual asset itself, because normally how the rules would work is you don't pay tax on the actual gain of that asset unless you sell it. But in this situation, you are going to be taxed on the gain, even if you're not selling the asset in that financial year, which is where a lot of people are getting concerned around, well, what does that mean for the future? And then could the government look at other ways of introducing this, which the short answer is no one knows. They could change the tax rules and legislation at any point in time. One thing I did find a little interesting though, Billy, and I haven't done a deep dive into the legislation on it, but I did see something along the sorts that government and judges may not actually be subject to Div 296 tax with their government pensions and defined benefits, which if that was to be the case, that does make you sort of question a little bit, even though a defined benefit account is, it is a little bit different to a regular superannuation fund, but there ultimately still is a value there, and there's going to be a pension drawn. I don't know, my opinion there would be is like, if it wasn't applied across the board and there was a carve out for the very people making the law here, I don't know how that sits right. Yeah, I don't know how you feel about that one, Billy.
Yeah, I mean, we probably most of us agree it doesn't pass the pub test, as they say.
No.
Like, yeah, because I mean, there's loads of people out there on defined benefits, and for anyone listening, a defined benefit, it's a different type of superannuation scheme, which used to be a lot more popular, and essentially means once you retire, you get a fixed income for life, as opposed to, say, having a balance that you're drawing on. And in the public service, these are really common. And of course, politicians and judges and so on get massive defined benefit pensions. And yeah, with this new tax, a lot of those people will be exempt from it.
Yeah. So we won't get too political on the podcast, but we'll leave the listeners to figure out how does that pass the pub test. But anyways, what I wanted to touch on, Billy, is there's also, with self-managed super funds though, there is rules around when you are say a director in a business, and say in my own situation, if I wanted to own all of my shares in the entities through my self-managed super fund because it's so tax effective, that would be great. But there are actually rules that prevent that from happening. The in-house asset rule, which basically stops, say in my situation, I can't have more than 5% ownership through a self-managed super fund in the business if it's a related party. So in this situation, Mr. Gibbons actually is a director in WiseTech. However, when you then look through into that, well, then how is he holding so much wealth through his super fund in an entity of which he is a director? So he's got some say in it. It's a little bit different because it is a publicly listed company at that point in time. So even though he owns a hell of a lot of shares and wealth in the company, he's not controlling in it based upon what he owns personally. So I had to have a look at that and just double check. But yeah, it's legal to be able to do that. It's a publicly listed company, and therefore he doesn't actually get caught under the in-house assets rule. Whereas if it was, say, a private company and he's a director and he owns a majority controlling stake in it, there are specific rules to capture and prevent business owners from doing it. Have you come across that one before, Billy? Have you ever had any clients sort of come to you around that in-house assets rule and thinking about try and pop their business through super?
Oh, look, we get clients all the time with all sorts of schemes they bring to us, as you know. And usually we have to shut them down. Yeah, I mean the in-house asset rule, like you can only have what 5% of your fund.
Yeah.
It's not worth the risk, right? What if you put that 5% in and it does a wise tech and goes up 10,000%? You'll tick above that 5% pretty quickly. So it's probably generally not even worth touching, I would say.
Yeah, no, exactly. But it is an interesting one because naturally when I saw the article, I'm like, hang on, how does a director have so much wealth in a company? But then, well, it's publicly listed, so it's a little bit different than your average private company. But it is worthy of noting for anyone listening that does want to explore self-managed super funds. Like generally, and I suppose us at Link, Billy, we generally look at them for owning property, because in regular funds these days you can pretty much own a lot out there. You can buy listed companies, ETFs, managed funds in all of the good funds that we would generally be recommending. But we do work around self-managed super funds for the right clients, particularly around property, or they want a bit more control and choice, I suppose, around what they can invest in. But if we also talk about, Billy, just what superannuation just being so tax effective, and even with Division 296 say coming in, which we've said doesn't actually affect the mass majority of Australians, a tax rate on super at 15%, a portion of it can be tax free after age 60 as well. It really is the best structure to invest in Australia, depending upon your actual circumstances, because you can't beat it. And even Mr. WiseTech over here is only going to pay a 10% tax rate on the CGT for the $200 million worth of shares that he sold in the current financial year. So superannuation is very, very tax effective. And do you want to unpack a little bit around that? The taxes and why it's just such a great structure from a retirement point of view, where we typically would just have clients focusing most on their super once they get to that point of time?
Yeah, for sure. I mean, even just quickly on the WiseTech thing, if he didn't have those, like let's say he had that shareholding not in the self-managed fund,
yep,
and he had it in a family trust or a company, he's still going to pay tax. You won't pay unrealized gains tax, but you'll pay any dividends that are being generated. It's all going to be, and then one day if he does sell, it's going to be subject to tax.
Yeah.
So it's not like there's some better alternative necessarily out there. Superannuation is still by far the best tax structure for the majority of Australians. Under the current rules, you can have $2 million in there per person, which has zero tax on it from 65 years old onwards. And then you can have, even with the new tax rule coming in, up to 3 mil in there where you're not going to pay more than that 15% tax rate. So if you're in a couple, double it, right? I mean, so even with people with a lot of wealth, they should still be aiming for 2 or 3 mil each, ideally, in super before they even consider other tax structures.
Yeah. And it's a good point you mentioned. I think part of the concern as well is around this $3 million value. And I think the Greens are trying to actually pull that down to be a lower ceiling. Yeah. So let's just work with the 3 mil anyway, as that's what it's looking like it's going to be. The concern there is, although most people right now, because super was only introduced I think it was in the late 90s, wasn't it? The super was actually introduced, the Keating government. But now people, when they first enter the workforce, like they have mandatory contributions going in from the get-go, whereas 60 and 70-year-olds now, like they didn't have mandatory super when they first went into the workforce. So the concern now is that like a lot more people will actually get closer to that $3 million cap because they're contributing from day one, and they're going to be contributing, start working at 18, you do that until you're 60. It's a long time of contributions, and then therefore more people are actually going to be starting to push those upper limits, which is I suppose where some of that concern ultimately does come in. But yeah, the point of what you were saying before, Billy, around like having it in other entities like trusts or personal names. So I'm sure Mr. Gibbons does have wealth in a family trust as well.
Yeah.
I'm 100% certain he's got other wealth outside of those WiseTech shares. But if it is in, say, if we took the assumption it was through a family trust, like you mentioned, that unrealized gain situation would not actually be occurring. But the way that some people would also then structure wealth in these situations, which we won't go down the rabbit hole of, is like through a trust. And he could have a an actual company as a beneficiary of his trust, and that would actually cap his tax rate at 30%, pretty much forever into the future, if those shares were held through the company via his trust. So, and I'm sure he's probably got a structure similar to that and does some other investments through that sort of a structure. But that's where I know there are people now in advance of this legislation and Div 296 coming in. They're starting to shift and move money out of superannuation, and then they're looking at the other structures that are around, like a family trust, or maybe putting some funds into an investment bond, because again, that's got a cap tax rate of 30%, and you can put as much money as you want into it in the first year. So I'll think, they are looking quite closely at some of those. And of course, those are things that we would do if we had a lot of clients that had a $1 billion superannuation fund out there. We would be probably looking at the same things for them. But what are the structures there, Billy? Have we really missed anything in terms of, if would you be telling clients, if they're around that $3 million mark, would you be saying pull back at this point in time? Of course,
Yes.
Not giving advice because we're not talking to anyone's specific situation, but what would you think about for a client in that situation if they're getting up there? What would you be doing?
Yeah, I'd be pulling back, because over 3 mil, you're going to pay essentially 30% tax, right, on any gain, realized and unrealized.
Yeah.
Because in a company, you're paying 30%. A company structure, you'll pay 30%, but only on realized gains. So you can decide, you're going to control when you're going to pay that tax.
Yeah.
And if you're owning assets via a trust, you can stream those income and gains to individuals, to a company, so you can have control there. Whereas this new super tax, there's no control. Your balance goes up, here's the tax bill. Balance goes up, here's the tax bill. I saw the way they're going to calculate it. They're even going to add back in, if you're retired and taking a pension payment from your super, they're going to add that back on. So they're capturing all the increase in value when they hit you with that tax bill. So I think it's been very much been designed to try and clear those people out who have the 3 mil plus, to try and encourage them to get that money out of super.
For
people who are fearful about the limit coming down, the current government won't do that. I think they've put themselves up for a big enough shit fight to get this one through. They're not going to do it. We never know what future governments will do. But I think the point is, for the vast majority of Australians, having 2 mil at least is very, very beneficial. You think about what age you are. If you're in your 20s, no, you're not going to go and stuff everything into super, because you're locking it away for decades. But if you're in your 50s or 60s, then you should absolutely maximize it.
Yeah, and I think the point there is really just being proactive and not reactive. And I always tell my clients, the way that we're planning and structuring this out right now, it's always subject to the government changing rules, and family trusts can always change. And it's just, that sort of speaks to the point of why clients do actually work with us on an ongoing basis as well, is because circumstances change, life change, legislation change, government closes, not necessarily loopholes, but how things currently work. And then we've got to adjust according to that. But I think today's podcast has been really good to unpack an area which a lot of people wouldn't really understand, and as we've said, nor really be affected by. But it's definitely good to, I suppose, keep a finger on the pulse of some of these things, and break down quite a rare scenario of someone who does hold so much wealth through superannuation, being in a publicly listed company. But we were even chatting, I think, Billy, the other day around even some other clients that could be affected by this would be say some farmers and other individuals who have actually bought assets so long ago, and these farms are worth a lot of money now. And I think that's the people that are going to be hit the hardest, though, is where it's a point to finish on before we close out here. If it's in, say, our guy, Mr. Wisetech over here, he's got all these shares, but he could trim off little amounts of that to pay his Division 296 tax bill every year.
Tax bill.
He's got no issues because shares are liquid. You can just trim off a little bit. Whereas, the farmer who's got a $20, $30 million farm in there, or a large property, or whatever it may be, you can't exactly trim off a little bit of that property, and you might not have enough liquidity in the fund to actually pay the Division 296 tax. So do you want to just throw a few comments in there, Billy, before we close out on that part about the illiquid nature of super assets?
Yeah, I mean, it's certainly there'll be a cohort where this tax is very, very unfair, and probably the farmer. The farmer is the one that comes to mind. They've got the family farmland, which they bought a couple of decades ago. It's risen in value, but they don't necessarily have a whole bunch of cash to like pay extra tax bills. And we don't want to be kicking them off the farm. So there's definitely a few victims who will get swept up in this. Probably the last note I want to end on is Mr. Gibbons, if he needs some tax structuring advice, because I don't know if he's had the best advice. He's really getting smashed by this by this new tax. So,
well, if he's listening, he's got to reach out to us on the Winners Playbook, because we're ready to go. So, and a good point in closing, of course, if anyone is listening and you feel like you might be affected, or you just want to have a chat about your situation and the planning for the future, because that's what we do as advisors. We look at the present and we plan for what the expected future is going to look like, and then build plans ultimately around that. That's what Billy and I do, and all the other advisors at Linkwells do on a daily basis. So if you've got a big balance, it's really not about time to actually panic. It's really about planning. Division 296 is a new rule, but super is still one of the most powerful wealth tools, as we have mentioned. And of course, if the episode gave you clarity, hit follow, leave a review, and send it to someone managing their money seriously. And if they want to get serious about their money, they can always reach out for a chat with either Billy or myself, or any of the other advisors at the business. But that was a good one, Billy. I enjoyed it, mate. And I'll see you next time on the Winners Playbook.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal situation. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.